This week on Moving Markets, Malaysia will keep its place in a key international sovereign debt benchmark. Bank Negara has revised its GDP growth projections, and major global investment banks suffer massive losses brought down by one little-known family office. Malaysia has retained its place in the World Government Bond Index, otherwise known as WGBI. On Tuesday, FTSE Russell announced that it is taking Malaysia off the watch list for possible exclusion. This is thanks to changes made by regulators in efforts to address concerns of foreign investors. Getting off the watch list and remaining in the index is critical because a removal could have triggered an estimated 25 billion ringgit in capital outflows from the local bond market, as the WGBI is tracked by passive funds. Such a massive capital flight would have also been negative for the ringgit, so the retention removes an overhang for the country. As part of its latest review, the FTSE Russell also decided that Chinese sovereign bonds will be included in the WGBI later this year. India and Saudi Arabia, on the other hand, are being considered for entry in the future. Bank Negara has also made a slight adjustment to the country's GDP forecast when it released its annual report. It is now projecting growth of 6 to 7.5%, down from the previous range of 6.5 to 7.5% in light of the second movement control order. It's worth noting, though, that the central bank forecast is optimistic relative to street expectations of 5.5%, plus this is subject to a smooth COVID-19 vaccination rollout. Bank Negara also signaled that it will maintain an accommodative monetary policy amidst economic recovery and said it will avoid a premature withdrawal of policy support as downside risks to the economy remain. So, the overnight policy rate is likely to remain at 1.75% for the moment. Wall Street has been rocked by the spectacular fall of a multi-billion-dollar family office, Archegos Capital Management, which is run by Bill Huang, a former hedge fund manager with a checkered past. Major banks like Nomura and Credit Suisse announced losses this week due to their exposure to Archegos. But what exactly happened? Well, Archegos held large positions in media companies like Viacom, CBS and Discovery, as well as Chinese tech companies like Baidu and Tencent. The fund did so via leverage, which is risky but fairly common. However, trouble arose when the prices of these stocks started to tank. As prices of Viacom, CBS and Discovery plummeted, Archegos lenders, which included Goldman Sachs and Morgan Stanley, made margin calls, demanding cash to cover bets they had made on Archegos' behalf. And when Archegos could not make good on those cash demands, the banks sold off massive blocks of the stocks, causing prices to spiral down. At one point, Viacom, CBS and Discovery were both down by about 35%. But the carnage on Wall Street was not equal. Goldman Sachs and Morgan Stanley were not the only banks that had extended credit to Archegos, but because they were the first to unwind their positions, they reportedly avoided any losses from the fire sale. Credit Suisse and Nomura, on the other hand, were slower to exit and suffered losses. Unsurprisingly, the banks' respective share prices reacted in tandem with their losses. Credit Suisse and Nomura are both down by about 19% on a one-week basis. In contrast, Goldman Sachs is down 1% and Morgan Stanley only about 2% for the same period. Typically, investors which hold significant positions in US-listed companies would have to disclose their holdings to authorities, in which case, banks may have avoided exposure to this risk. But Archegos was able to quietly increase its large holdings in those companies through a type of derivative which is exempt from disclosure requirements. So, for capital markets, the Archegos saga raises some serious questions. Are there perhaps small firms like it waiting to implode? And could Wall Street see new regulations? We'll just have to wait and see, and that's what's been moving markets.